Learning objectives. At the end of this concept, you will be able to identify the components of the balance sheet, explain the impact of each transaction on the components of the balance sheet, identify reasons why a balance sheet always balances. Ted is the manager of Smart Fashions, who are into the business of making and selling garments. He takes a showroom on rent for the business and moves in. First, he buys furniture, and next he acquires the stock. Now that the showroom is fully stocked and nicely decorated, he is all set for business. The shoppers keep pouring in and sales are up. Ted is really happy counting the money. With the sales being up, Ted feels the need for a company car to help the business, so he buys one. It is 3 months from the time the business started. Ted needs to know where the business stands, and he finds all his answers in the balance sheet. Ted will share with you the balance sheet of Smart Fashions so that the concept becomes clear to you. Assets, liabilities, and capital are the 3 components of the balance sheet. The possessions of the firm which result in future economic benefit are assets. For example, the machines, furniture, textiles, car, cash, and fixed deposits possessed by Smart Fashions are all assets. The firm has full rights over receivables and prepaid expenses, which result in future economic benefits, and therefore these are also treated as assets. Any fund put into the business by the owners is capital. The funds provided by outside agencies, such as a bank, are liabilities for the business. Goods received by the business for which the firm is liable to pay is also termed liabilities. The unique feature of the balance sheet is that at any given point in time, all business assets are equal to business liabilities plus capital. To understand how a balance sheet is prepared, let's look at 12 business transactions of Smart Fashions over one financial quarter. Ted is the manager of Smart Fashions. On 2nd January, Ted receives 25,000 euros from his father Ben to start Smart Fashions. This amount introduces capital into the business, which increases the liabilities. The amount is then deposited in a bank, which increases the assets. Both sides of the balance sheet add up to the same total of 25,000 euros.